Today's an interesting day to have a get-together like this because for those of you who were watching the market, you saw quite a bit of excitement, and excitement's been the name of the game. As Susan intimated, we've had one heck of a lot of volatility over the past many months, and I jotted down the progression of points here today just because they were noteworthy. I'll use Dow points because I think that's what most people identify with. But yesterday, the Dow Jones Industrials were down about 250 Dow points off a high, which we'll talk about in just a little bit. This morning opened down about another 100 points or so in the early movement. Kind of recovered that and added another 100 to it, so it was plus 200 when a rumor came out, yet unconfirmed nor denied, that by The Guardian in England, that Germany and France might increase the size of the European Rescue Fund to the level of about 2 trillion euros, which would be the shock and awe type number that some people have speculated about. Well, the market took about 5 minutes to rise another 150 points, dropped 100, rose 80, fell 80, and then kind of moved up slightly for another 25 points or so to close up 180 for the day, which took back most of the decline that occurred yesterday. So a big day, the kind of thing that we've seen in one measure or another over the past number of weeks, even last few months, as there's been almost daily speculation about what was going on in Europe in the negotiations as to how they were going to, number one, bail out Greece, or number two, how they were going to deal with the various banks throughout Europe that were significantly affected by the European debt crisis. So we'll touch on a number of those things as we get into the discussion here this evening. I'd invite you to open the booklets that we have there to that first page, which I normally like to start with just a fairly recent picture of the stock market. You have here the S&P 500 on a daily graph. That means each of the little black lines here, vertical lines, trace the movement of the S&P 500 in the course of one day. And this graph takes you from yesterday's close back a little more than a year into September of 2010. Market obviously climbed a mountain here up to one peak, a little dip. And it reached its high to date here in this long recovery in the beginning of May, and then kind of formed a bit of a top along in here, fell off the cliff for a while, and then we've been in a very volatile trading range for the last 2 months plus, from about 1100 on the downside here to about 1220, 1225 or so on the upside. We had one just about 2 weeks ago, had a kind of a quick breakdown on a Tuesday morning below that range, and then intraday it was recovered upward, and then we've had a very powerful move since then to the upper end of the range, where it started to encounter a little bit of resistance, but we'll wait and see. There was a lot of strength late in the day, albeit rumor related, but in an overbought position, when you start to see fairly significant strength late in the day, that might be a sign that it's going to try and break out above that area. It is running into the 200-day moving average on this graph, which is a decision point graph. They use moving averages, exponential moving averages rather than plain arithmetic moving averages. So this is a 200-day exponential moving average. I personally like to use just the straight arithmetic ones, but the differences are not very significant. In any case, that one is a little bit above where we are right now in the 1234 range. So not too far above where the market currently is. And an awful lot of technicians look at the 200-day moving average as the dividing line between bullish conditions or bearish conditions in the market. And a bearish condition, as one would consider this below the 200-day moving average, is confirmed to be a little more, the bearish condition is a little more strengthened if the 200-day moving average has started to move down, as this one has. We'll see whether that continues. This sort of thing can reverse, but 200-day moving averages tend not to have too many whipsaw moves, but we'll see how this one proceeds. Obviously, when you look at this kind of activity in here, there was a very tough third quarter. The S&P 500 was down 13.9% for the third quarter of 2011, and that brought it down to a minus 8.5 for the year to date. Now, the strong rally that we've had here in the last couple of weeks particularly has recovered some of that loss in year to date, so the market through today's close is only down about 1% year to date after that really good rally. We were pleased. We were at least slightly positive for that very tough third quarter and positive for the year to date as we are right now. Stock market problems are certainly not limited only to the United States. If you see on the second or the next page, I guess it's page number 3 because they have the cover page counted as 1, but there you see that it's not just the U.S. but the world markets are declining also. This is a Ned Davis Research Corp graph, and they do a tremendous volume of research work. In this graph, what they're showing you at the top is the MSCI World Index over an extended period of time from the end of the 90s on to present. And that, if you were to overlay this and the U.S. index, they're fairly similar. They aren't dramatically different, really, in most of the time periods. And then below that, what you have is the percentage of the 45 foreign markets that they monitor through this study, and what percentage of them is trading above their respective 200-day moving averages. As it turns out, only 2.22%, which means one country out of 45 is trading above its 200-day moving average. And as you saw on the prior graph, U.S. is also trading below its 200-day moving average. In the bottom third of the graph, you see the percentage of those 45 markets for which or in which the 200-day moving average has already rolled over and is descending. And there are still a few that are still not descending, and that's 11%, and that would be 5 of those 45 countries still have 200-day moving averages that have not rolled over. So clearly this is almost a universal bearish condition right now. That's not a forecast, that's an observation. That's where things are today. Take a look at the longer term picture in the United States on the next page. Here we have the S&P 500 as the top graph, the NASDAQ composite as the bottom graph, and it covers a long period of time from the end of the 1980s through the tremendous peak up in year 2000, big decline into 02, 03, big rise into 07, big decline into 09, and then the big rise here up into May, and then the decline that we've seen since that time. With all of those gyrations, for the S&P 500, we are back where we were at the end of 1998. So we've gone almost 13 years now, essentially treading water above and below today's level. On the NASDAQ, it's in the middle of 1999, back in here. So it's very similar, even though the NASDAQ took a far more dramatic rise up to its peak in 2000 and then a far more precipitous decline down into the 02, 03 bottom. But as it's all leveled off, it's about where it was at the end of the 90s, as is the S&P 500. Through the end of the third quarter, stock returns are negative over in the United States over a 4-year period, 5-year period, and century to date. And the average investor has lost money owning stocks since the century began, because the average investor does not do as well as the averages. That's just a historical fact. So the average investor has not made money this century yet on balance for the whole time period. But because you've got such large price swings in there, you've got some time periods that are positive, some time periods that are negative. The best return on a multi-year time period is the 9-year return. So if you started counting at the end of the third quarter of 2002, you've got a 5% per year positive return in stocks. Conversely, if you started at the end of 2007, so your 4-year return, you have a negative 5% per year return. So the swings really indicate that how you've done from whenever you start counting to now depends a lot on when you start counting. So it's been a very volatile time period. And basically we see the same story playing out over the century to date. If you turn, you don't have these in your book, I don't think, but Carrie, if you can move to that other graph. This is just something I came upon this morning, or thought about this morning, and so I added it. This picture comes off my computer, and it was the kind of the lead picture in a blog post that I put up on June the 10th of this year, where we were looking at this. In this case, it's the Dow, and this is a monthly index, that little M there. So each of these vertical lines represents the price movement of the Dow in a single month. And you see the general pattern that we were talking about and looking at on the other graph. At that point, what I did was just draw some of these connecting blue lines, trend lines, connecting the bottoms of that move up, and then this move up, and then the most recent move up. And the price at the time was right there above that line at, excuse me, I said this is the Dow, and most people listen and say that's, oh, the Dow Industrials. This is the Dow U.S. Total Stock Market Index, excuse me. So this is like what used to be the Wilshire 5000, where it's the greatest collection of stocks we accurately measure. I don't know how accurately, but I suspect it's accurate. In any case, so this is pretty much the total market. And what we saw in these three instances, although in varying lengths, was a pretty similar rise with connecting points along the trend line. And the question that we asked there was whether or not we were, in the article, was whether or not we were likely to break down below that line, and if so, would there be a similar sort of response after the market, if the market broke and after the market broke. If you look to the next page, that's it, Carrie. This updates it through yesterday, and of course all of this stuff is the same. What we did was break down sharply through that line, and the pattern after we broke is fairly similar. If you look at what happened over here, we broke sharply, but then came right back and actually rose slightly above the trend line before fading and then going lower. Same pattern here, sharp break, then a recovery. Didn't quite get back to the trend line, but it was a pretty good recovery. And then finally it fell off and fell away. Likewise, in this instance, it's broken sharply, and then it started back up, and it may or may not continue back up to the trend line. It would take about another 10% up move to get it up there right to the trend line. So that's certainly possible, at least off the past two precedents, and we may or may not see that. In any case, it's kind of an interesting, somewhat repetitive pattern, and it's not an unusual action for a market or even an individual stock to break below a trend line that a lot of technicians may be watching and that precipitates selling below that level.